Hello everyone, good afternoon, good morning or good evening wherever you are, and welcome to the Trailblazer 2.0 webinar on hotel investment and finance in the future different. Now we have a lot to get through today. We're going to be discussing pardon me, funding options, recent transactions, investment opportunities, and all of this with a look to the future. So let's get cracking. So the full Trailblazer series is in the run-up to the Urban Living Festival, which is a live event that we are hosting this summer, July the 7th and the 8th at Tobacco Dock in London. It's set around 3 stages called Stay, Live and Work. And on your screens now, you can see a list of the different hospitality and real estate asset classes that we are going to be featuring on the day. So a link to the Urban Living Festival website has just been posted in the chat. And from here, you can read more about the agenda and our speakers. So some housekeeping rules before we begin. We're going to spend around 45 minutes chatting with our Trailblazers today. And if you do have any questions, please use the Q&A function and I'll get round to asking these at the end. The webinar is being recorded and everyone that has registered will receive a copy of the recording within a couple of days' time. For those of you who don't know me, my name's Louise Gillon. I am the news editor at Boutique Hotel News. We are an online B2B multimedia platform publishing news, comment and opinion from across the boutique, lifestyle and luxury hotel space. And the site itself is published by International Hospitality and Media, host of the Urban Living Festival, and we run 2 other sites at Service Department News and Short-Term Rentals. So here we have our Trailblazers, and I would like each of them to introduce themselves briefly, and I'm going to move from left to right as per the PowerPoint. So Ben, can we please start with you?
Yeah, hi Eloise, thanks for having me on. Managing Director across 3 businesses. We have Watergate Bay Hotel in Cornwall, we have Beach Retreats, which is our self-catering or vacation rentals platform, and we have Another Place, which is our hotel brand for growth. I'm sitting here in our lakeside hotel in Ullswater, looking very beautiful and very empty, sadly. And we just bought our 2nd site for the Another Place brand in Hampshire this time last year, almost to the date.
Thanks, Ben. And it won't be empty for too much longer, I can tell you that. Greater times are coming. And Louise, can we move over to you, please?
Yeah, hi. My name is Louise. I'm the head of hotel finance at Leumi UK. We're financing assets throughout Western Europe, active in straightforward acquisitions, refinancing, but also more in the specialist development area.
Brilliant. Thanks, Louise. And Kim, can I hand over to you next, please?
Absolutely. Hi, everyone. Thank you for having me on, Eloise. Kim Bardoul, partner with the Highland Group. We advise on hotel investment, and we are going to be your U.S. portion of this webinar, as that's where we deal mostly. And I am author of a report called the Boutique Hotel Report. And we've been measuring for probably about 6 or 7 years the growth and investment opportunity for the boutique hotel product in the US.
Thanks, Kim. And handing over to you next, please.
Thanks. Hi, thanks, Ellie. It's Tim Helliwell from Barclays. I lead our large corporate clients in the hospitality and leisure space. I also head our hotel practice, which covers everything from single asset country house hotels right the way up to the global majors across UK and Western Europe.
Thanks, Tim. And last but not least, Tom.
Thanks, Eloise. I'm Tom Oakden, Managing Director from Hilltop Hospitality Advisors. I work on originating hotel investment deals for investors. I also work with owners who are looking to recapitalize and reposition businesses and I'm also involved in some hotel fundraising at the moment as well.
Thanks, Tom. And all the LinkedIn profiles of our Trailblazers have been posted in the chat, so please do connect with these guys. And I always find it helpful to offer some background to our conversation today. And here's some headlines that I've published over the last month or so. And two stories which stand out for me on this page. We have the partnership between Reuben Brothers and Baglioni, along with Faina and Accor. The Baglioni story, to me, highlights a very strong vote of confidence in luxury hotels, and particularly when this segment has reportedly seen the most severe declines in RevPAR. It also speaks to the power, and in this instance, the Baglioni name, and we're going to touch on this later in our conversation. And the Faina partnership with Accor followed very closely from Accor's announcement about its merger with Ennismore and the creation of a new lifestyle entity. And I've noticed that lifestyle hotels seem to be taking centre stage at the moment in terms of what consumers are going to be looking for, and in turn, what's going to be attractive for investment. And we will again be looking into this further in our conversation. And on the next slide, awesome. On the next slide, we have some recent acquisitions, and I must highlight the top left-hand story here. This is London's Boundary House is an office block which could be repurposed into a hotel and serviced offices. And there are great opportunities to be had when looking at vacant offices and retail stores. And I expect the high street is going to look very different over the next few years. And whilst we're on this page, I would also like to mention the top right headline. It reads, European hotel transactions in 2020 exceeds 10 billion euros. And this is data from Cushman and Wakefield, which revealed that hotel transaction activity remained resilient. About 43% of the deal volume took place after the pandemic outbreak, and close to half of the total transaction volume came from institutional investors. Interestingly, or perhaps not so much of a surprise, the share of non-urban transactions also increased to over 41% after the virus outbreak. And we are going to discuss how investor sentiment has changed throughout this time. So without further ado, let's talk about hotel investment and finance in the future different. And I would like to begin with Kim. Could you please give us an overview of hotel performance in the US?
Yes, absolutely. So overall hotel performance in the US in 2020, demand was down by the year end 36%. Occupancy finished at 44% from 66% in 2019. ADR went to $103 from $131. Upper upscale class seemed to suffer the worst, down 59% in RevPAR, followed by luxury, which was 56% down in RevPAR. Least down was economy, which that's been kind of interesting. The economy, and especially the economy extended stay segment of the overall US hotels are seeming to be more resilient. Locations hit hardest was urban, down 54% in RevPAR. Interstate locations were the least down at 22% decrease in RevPAR. So overall, you know, as you guys have experienced, I'm sure it's been kind of dismal, but we are very optimistic and see already some glimpses of recovery.
Mm-hmm. And how are you forecasting for the rest of the year? What's your take on the market and what's going to happen?
Sure. So when developers began again reaching out to us, it was a daunting task because who knew? But as we have finished out 2020 and as we have seen specific segments and specific locations beginning to recovery, we realized that there will be obviously a recovery. There already has been. We had some lockdown fatigue here, and leisure picked up in third quarter and fourth quarter. And so we're forecasting market by market, of course, but overall expecting nominal RevPAR numbers to get to 2019 levels by 2023, 2024. Of course, the interstate locations, I've done some studies on interstate locations already that are high leisure, and we see a lot of that coming back very quickly. So that's kind of how we're looking at it. The ones that are affected most by group are international travel. You know, those are going to be the slowest recoveries.
From my conversations, any time frame for recovery definitely seems to be placed in between 2023 and 25. So yeah, well, I mean, if it can happen sooner, fantastic.
Yeah.
And I'd like to, yeah, must stay positive. And I'd like to move on to speak to Tim. I know that at least here in the UK, hotels still have another 2 months at least before they can reopen. And I know that one challenge for hoteliers has been the access to debt capital. So can you talk us through what are the funding options for hoteliers and how can debt be sourced?
Sure, thanks, Ellie. I think one of the key messages that have come out literally over the course of the last fortnight or so is certainly clients are telling me that they are starting to see or feel a degree of confidence now about the future. I think the combination of the vaccine program and the roadmap, and you know, roadmap could be better, but at least we've got a roadmap, and of course the budget. All these things are certainly from some of the clients I'm speaking to, they're starting to feel a bit more confidence about where things are. In terms of debt capital, I think it's really important. Actually, we're talking about capital, which can be a combination of debt and equity. And I think that's going to be a key component for discussions going forward as we look to recover over the course of the coming 12 months. I think it's really important just to emphasize, you know, how huge the lending program was in 2020. And, you know, certainly for affected sectors, which of course hospitality and leisure was a huge one. Just to place it into context for, you know, Barclays, you know, and we've got about 20% of the UK market. We lent to, I'm going to call SMEs and non-public companies. We lent 14 billion pounds last year by way of bounce back loans or the civils or the CL bills. And that's on top of another 14 billion to the quoted sector. This is not all hospitality and leisure. This is across all affected sectors. But we've got 20% of the market in terms of, you know, sub quoted groups. We lent 14 billion. So there's already quite a lot of leverage on borrowers' books. And of course, that's in addition to all of the other work that we've been doing around supporting on covenant resets and capital repayment holidays and whatever else was required to keep our customers going. So coming back to the point around capital, I mean, the one great thing about this situation, perhaps compared with GFC, is the variety and depth of capital that's available. Whilst to an extent, you know, the banking sector is still relatively internally focused on its existing clients, there is still a huge range of options out there. Equity, preferred equity, senior debt, junior debt. We've just recently heard the announcement of the new government loan scheme, the recovery loan scheme, which is going to replace the existing schemes. So there's a lot out there. And indeed, one of your articles covered Apollo's additional funding into Generator as a classic example. And I think the point is, it is going to be a mix of equity and debt. But how to access this? Well, I think first and foremost, from where we now sit it's all about what is the strategy of the business in question. You know, what's the flight plan for your specific business? And then from that, you have to be talking with your advisors and your relationship lenders, arguably starting with your senior debt and then working through in terms of what additional funding you need to hit your flight plan. So I think it's all about talking with your bank, talking with your advisors. I think the important point to make is that, you know, whilst this has been an incredibly challenging, you know, I mean, I was a banker to the sector around GFC, and dare I say before as well. Certainly, this last 12 months has been, you know, incredibly challenging and intense. So I can definitely feel that we can see the way out of this. And just one other anecdotal point, just talking around wider banking portfolios. I think, yes, they're stressed, but I don't think that they are distressed. I think, you know, I think that's the positive point I'd like to leave. So how do you find it? It's all a question of what your strategy is and what your needs are. Talk with your advisors, talk with your banks. There's a range of capital out there, of which debt and equity will be the key components.
Mm-hmm. Thanks, Tim. And you just touched on something there about you know, properties being stressed, not distressed. I think many were expecting a lot of distress on the market, and yet, you know, nothing as of yet, at least nothing notable anyway, which brings me on to Tom to look at what's been happening in terms of the hotel transaction market and the deals that are unfolding. What are you seeing, Tom?
Well, Eloise, I think just put it in some perspective. I'm going to look back a little bit into the last quarter of last year and where we're at now, and also take a bit of a global perspective, because, you know, this is a global pandemic. You know, when we had the GFC, different pockets of the world came out of it at different times, and Asia, for example, recovered pretty strongly because it was very underleveraged compared to the Western world. So we have something quite unique in that sense. It's not going to be a synchronized recovery, of course, but it's interesting to look at deals, and I've got some examples in the US and also Australia. But at Q4 2020, there were limited numbers of transactions, and part of that was because of the life support that the government and also the banks, with their forbearance, were giving owners of hotels and other real estate as well. So we didn't see that many transactions, and when we did, we had sellers holding on for too big a price and buyers not wanting to push up on price. So what we call a bid-ask spread persisted, and it was quite a big spread. However, investors were very excited about the prospect of investing billions of dollars into hotels because of it being the ultimate recovery sector. Given the results at that time of the vaccination program and the tests that had been successfully carried out, and also the likelihood that investors could buy assets at below replacement cost, and they would see a spike in leisure travel, leading to corporate and business and convention travel as well. So this was sort of the expectation going into Q1, but of course it didn't really happen like that. We had lockdown 3, so we had more government support measures. We had extension of furlough. We had banks that were more forbearing. You could call it forbearance on forbearance. And as a consequence, owners, investors haven't needed liquidity because they've had liquidity from this life support system. So we haven't seen the distress sales that you mentioned as well earlier that just haven't been prevalent. But meanwhile, you've got billions and billions of dollars wanting to invest into hospitality, into hotel real estate. And it's pent-up demand that really needs to be deployed, because these funds, the clock is ticking. If they don't invest, it hits their return. So they have to invest. So what we've actually seen is this really bizarre situation of assets that have come into the market, whether they're single assets or portfolios, and we've been seeing multiple bidders. We've been seeing asking terms being met. We've been seeing multiple rounds of bidding, and we've seen contracts being marked up in third rounds from multiple groups, this is kind of happening before the GFC, and it's happening at a time when hotels aren't opening, they're not owning cash flow. So it's all predicated on the future and the market recovery, as well as what owners believe they can do with these assets. So we've actually seen the bid-ask spread really surprisingly move from the buyer to the seller. The seller's getting close to what he wants, but the buyer is having to pay above the discount that he would ordinarily want. And another real irony is that there is very little debt available at the moment as well. So bidders who are aiming to close deals are basically only doing so on a cash basis. If they are bids predicated on debt, then they won't be included in the shortlist. So it's a really bizarre scenario. And just to give you an example, kind of big pictures example, we've got an administration sale in France at the moment, in Paris. It's a portfolio of assets that have been in receivership for many years, which is quite typical in France. It does take a long time to unwind. It was an auction bid, and there were 53 bids for this portfolio. In the UK, we've seen a portfolio which is provincial. I wouldn't call it grade A portfolio, probably more like a grade B, but still upside potential if you buy it well. And we're in a third round with 5 groups marking up contracts, again, in competition, which is great for the seller. And it means the seller will get closer to what they want, even if it is still at a slight discount, but the bank will come away with more money than they expected, and there might even be some equity as well for the seller. We've also recently seen some bids in for a provincial city with a key asset in that city. Again, we've had 12 bids, we've had offers at asking, we've got a second round of 6 people. So is this a time to be a seller? Absolutely. If you need to sell, I'm not saying you must sell now, but if you need to sell for strategic or other reasons, you need liquidity, now is absolutely the best time in the cycle. If we take a look at what's happening overseas, say in the US, we were expecting a lot more distress there because there's $146 billion in real estate debt. And would you believe 2/3 of that is on hotels and retail? 2/3 on hotel and retail, which is quite remarkable. So the floodgates were expected to open, but they haven't. There has been distress. For example, last week, a mezz lender took control of 7 hotels in New York. So yes, there is some distress if the lender chooses to foreclose. But what is happening is lenders are not choosing to foreclose because it's not considered a desirable asset class for them if it's not earning any money. So they're working with their borrowers to sort it out. So it is again not an expected situation. The distress was really expected to start coming from the States because of that debt burden and the way in which they are able to sort of accelerate the foreclosure process particularly through their structured finance loans. So we've seen that, but we've also seen something which I think gives us a bit of a guideline into what might happen in the future in UK and Europe as we go forward. And that is that we've seen some groups strategically selling assets. For example, Omni, who own about 60 luxury assets, have just sold 5, 4 in Texas, 1 in Florida, and they're reinvesting the proceeds. Yes, it gives them liquidity, but also they're looking to reinvest in sectors that they would prefer to invest in, i.e. resorts, and quite interestingly, into the convention centre market as well, where I think they feel they can buy very cheaply, perhaps even 50 cents on the dollar, and then build up from there. In Australia, we've seen also some strategic sales. We haven't seen distress. We've seen an asset sold a few weeks ago by Greenland Group, a Chinese group, for 132 million to Pro-Invest in Sydney, the largest deal in Australia since the lockdown. And it was a non-core sale in competition, and quite a strong price resulted. So that's kind of where we're at the moment, and that's kind of where we might be going with the situation that unfolds in Europe.
It certainly is encouraging to still see deals, over the line. As you mentioned, they're strategic strategic sales as opposed to that distress. And you highlighted, Tom, quite a few city-based assets and hotels, which brings me on to Louise to talk about whether you see long-term value in city centres. Obviously, I highlighted earlier that there was a 41% increase in non-urban locations, you know, after the virus outbreak. So what's your take on the value of the cities?
Yeah, I think that there's still value in city centres. I mean, we're talking a lot about the change of how we're going to work going forward, and we're concerned about the impact on, you know, office accommodation and so on, with us all working really quite productively at home remotely. But I think the reality is that we're all craving the social aspect from both personal level and also from the professional level as well. And therefore, I think people have really appreciated just the value of all being in a, let's call, central hub together for brainstorming and creativity and so on. And so therefore, I don't see the need for city centre hotels falling. I think how we travel going forward will change. We're perhaps less frequent. I think we've all enjoyed not having the commute, and I think we don't want unnecessary commutes. So therefore, we're probably going more for quality travel, even for work purposes. Instead of one night here every month, it might be 3 or 4, and actually get some value out of that trip. And I think then there's some impact into what we want from city centre hotels, that we perhaps don't want the standardised product anymore if we're staying there for a longer term. And I think there's going to be an impact on city centre hotels. They need to stand out from each other on more of a personalised level. And I think the lifestyle sector will grow as a result, because they are much better placed to be able to provide this personalised experience that we're going to be looking for. And that sector was growing pre-pandemic, and I think just like everything else that we've seen, there's just now a real focus on driving that forward, and it's going to grow quicker than perhaps it would have done before.
Mm-hmm. And with all that in mind, Louise, how would you define the next generation of hotels? Perhaps something that you know, Leumi UK is looking at, you know, investing in and funding.
So we're looking at a lot of the boutique products at the moment. I think that hoteliers have perhaps been slow to adapt previously, and now there's an impetus on adapting. Standing out from the crowd, from personal service, you know, whether we will be doing more of the leisure side of things, that we're working, you know, whilst holidaying, now that we can work remotely, and vice versa. We're, you know, making the most of actually going away for work and needing other services that go along that. We might be calling down for, you know, room service to bring us a computer screen to make it easier for us to work, as opposed to, you know, the previous another blanket, please. So I think our desires for what we need from our hotels will change to fit in with our changing lifestyles, and how we finance that is another matter, because obviously with the evolution of the hotel product, there's an evolution of the cash flow of that, there's an understanding of that, and yeah, it's going to be interesting movements coming up as to how hotels do adapt and how quickly they adapt.
It certainly is going to be exciting to see, you know, as you highlighted, Louise, what's going to happen. And it's definitely the last 12 months, as we've definitely seen a lot of creative and innovative solutions to what you might call the traditional hotel product. And I'd like to move on now. We've just focused on city centres, and I would now like to bring Ben into the conversation. You've got hubs based in domestic leisure markets, which will inevitably help to drive the recovery. And I'd like to ask you, how are you looking beyond that, what we call the staycation boom here in the UK?
I think, again, to step back, a domestic audience isn't a new one. We've built a business pre-COVID that was booming as a result of very fast-paced growth domestically, and that's as a result of a very low amount of high quality lifestyle brands and products out there in the market, which presents an opportunity, presented us with an opportunity again pre-COVID, but also this consumer shift in the sense that to stay local and to be local and to seek real experiences close to home. And I think to Louise's point, this is not a new trend, but it is significantly accelerated. And I think if I was to think of this as a boom, then I would probably be a bit short-termist. We see a huge opportunity, and I'm trying to rationalize it just from on a personal level. I think people who have tried to book a UK holiday this year will probably be able to understand my point around the fact that it's either super expensive, it's either full, or you're really anxious about booking it because the quality, the brand, the lifestyle elements of what you're looking for in a holiday experience are not there. So I suppose I'm very confident about the short term, and I stood in front of the team on day one of lockdown 12 months ago and said our business will reboot quicker than most, and I feel very fortunate for that. But I feel super confident about the medium to long term as well, as I think there will be a little dilution as the pent-up demand for international travel is clearly there. As soon as people can get on planes, they will. But again, because there is such an inconsistent landscape by way of lifestyle, leisure, non-urban brands in the UK space, I think we have an opportunity. And I suppose I'd flip that question back to the financiers on the call to say, do they see that? And are they looking at hospitality within these little sub-segments, either by way of lifestyle versus urban, so lifestyle versus corporate, or urban versus rural? And I suppose that would be one of my messages to the financiers, to think about the sub-segments within hospitality as they behave very differently. And I think this last 12 months has really demonstrated that.
Would either of the financiers like to add to this? Do you see the opportunities for these sub-segments?
From a financing point of view, I have to say that our appetite is city centre, main city led, and historically these more urban hotels they had a higher level of seasonality, which created some uncertainty about how you could put a financing structure around them. So I think from Leumi's point of view, we have always looked at them as the higher end of the risk curve. How they evolve, whether or not our appetite changes because there's more sophisticated management around them, that's a good question. Because I think previously they've been smaller assets and they perhaps haven't had the sophisticated management structure that the main city centre assets have. And perhaps with a limited insight into trading capabilities, STR global reports and so on and so forth. So I think with more investment going into those sorts of assets, then the transparency would probably make them more bankable from our point of view, but it's not something that we've historically been active in.
The nature of the model in sort of the non-urban environment lifestyle space is that because they're smaller sites, then you have to have rates and you have to have occupancy in order to really drive the profitability of these hotels. And fortunately, that's something that we've been able to do. But again, I completely take the point. Where these businesses are really successful is where you can take that seasonality out, and that all points to brand. And that's something that we live and breathe by. So, I mean, I would say that funny enough, we did some research on staycation and leisure travel a couple of years ago, and we were seeing already how people were wanting to holiday and take time in their home market. I think we're very aware of micro markets. So the success of a particular hotel in a particular location with a particular management team and a particular proposition is always going to be a winner in our view. And I think if you look at some of the mega trends in terms of, one piece of research that came through loud and clear was how people were having a really positive experience when they were holidaying at home. As an example, it can be business as well, but
how they are having a positive experience rather than the need to go away. When I mean go away, I mean go abroad. And so I think I guess because of our coverage is this is our home market. We've funded a number of these propositions anyway. But we go back to micro markets and micro propositions are the key, and we've seen they can be incredibly successful.
And coming back to Ben, with all this considered, off the back of all these changing needs, have you identified a gap in that market for future growth?
Again, I'd like to think that we identified the gap a few years back by way of opportunity. We've done nothing differently. We have three brands who firmly position themselves in a lifestyle, domestic, leisure market. I think the one opportunity that I'm spending a bit of time thinking about is this small corporate group stroke retreat space for those teams who want to get off Zoom and come to somewhere like another place to lake, hang out, stand up paddleboard, lake swim, but have great hospitality and maybe do a bit of work around the edges. But it's more about spending 2 days as a team connecting and getting out there, walking up the fell, again, getting in the lake. And I see that as an opportunity, but it's kind of gravy on top from our core. And again, to Louise's point, the more we do of that without losing our brand focus, it takes some of that, it takes seasonality away, so you can play different segments at different times of the year.
Well, certainly sign me up to some team paddleboarding in the lakes. I'll be there without a shadow of a doubt. And Tom, I'd like to bring you into the conversation here. We've talked about changes in consumers, in consumer tastes and needs, but are you observing a shift in investor sentiment, and what's proving attractive?
Well, just coming back to the discussion with Ben, and outdoor tourism is proving increasingly attractive. It's not deemed to be core, and certainly, again, as Tim and Kim said, Louise said, it's from a finance perspective, it's not core as well. But two of the largest hotel deals, hospitality-related deals, in the last year and a half, in fact, the last 3 deals have been outdoor tourism related. If you look at the Butlins deal with Blackstone, enterprise value of 3 billion, KKR taking over Roompot, which is a caravan park operator in Europe. That was the biggest deal of last year. That was 1 billion. And then just before the pandemic, Around Town spent 1 billion buying 7, what are they called? Blackstone used to own them. The leisure resorts in the UK. The name escapes me, but it will come back to me. Centre Parks, yeah, that's one. I've never actually stayed in one. That's probably why I couldn't remember it. Although I know they're very popular particularly with folks with children. So this happened, and then last week we learned that in Paris there was a deal which Apex partners were involved in, and they sold a majority stake in, let me say, a French leader in outdoor accommodation, which is effectively tents or a campsite. They sold a stake which they bought in 2016 for about 170 million. They sold it for 450 million to a group called Infravia. Now, I don't know if a lot of people on the call have heard about that deal, but that's a pretty significant deal. And I think we're going to see a lot more of those and a lot more people willing to invest in that sector. Opportunities to invest in core leisure related assets, resorts are still there, of course. But here's a thought about those. There might only be a really short window for people to invest and acquire value propositions, because as soon as the cash flow starts returning to these resorts, owners are going to be less inclined to sell. And that's pretty significant, because if they're not selling, where's the money going to flow? We're not going to see many sales, perhaps. So it's going to mean that a wall of capital will move to another sector, with a segment within the within the hotel sector. Does that mean it moves to the city centres and looking more at corporate hotels, convention hotels, that you might be able to buy at better distress levels or better discount levels that have recovery prospects, albeit slightly harder to determine, i.e. you can buy at better value because there's greater risk. So we might see a little bit more of that. I think we're also going to see a lot of investors aligning with owners that don't really want to sell, but they want to get greater liquidity in their business. They want to survive, but they want to grow and thrive. And that is going to happen as well. And these might be more under the radar type of deals, not open market deals, but owners that align with a partner and sort of recapitalize and rebuild from there. So I think we're going to see more of those type of deals as well. Again, are we going to see a flood of distress on the market? Well, probably not, because of the way the recovery is happening.
Thanks, Tom. And I know we've all kind of touched on brands. It's been, you know, in the conversation, but we haven't really talked about brands as of yet. I just wanted to highlight some polls that I ran a few weeks ago on a webinar. It's interesting results. First poll that I ran, it was around the value or the power of a brand and whether this had increased, decreased, or stayed the same as a result of COVID. The answers to this first poll came back. Over 60% of the audience agreed that it had increased. In the same webinar, I did a later poll, hypothetically asking that if you were to open a hotel this year, would it be branded, soft branded, or independent? And the majority voted independent. I think it was around 40%. So we have two very different results. But now I'm curious to hear a lender's perspective onto the conversation. I'd like to come to Tim and ask whether brands, you know, are they more favourable when it comes to securing funding?
I think in general, I would say yes. If you look over the past 15 years or so, especially as new lending capital came in to the sector, they typically tended to focus on brands, and that's just because they found that they could understand them more easily, and you know they felt comfortable with that consistency of offer and the operation, and you know, and of course the distribution system that often was allied to the brands as well. I think it's been fair to say that the trend over the past decade has been away from independence. I mean, I think market share for independence in the UK was, I don't know, 57% 10 years ago. It's now down at 48%, and certainly GFC had accelerated that decline. And some may say that COVID may do the same now. Certainly from, you know, covering some of the large brands here in the UK, I've seen that when they have been open last year, they tended to outperform in general, I would say. That said, you know, frankly, we're agnostic. We fund both. We do brands and we do independents. We, to my point I mentioned already around micro markets, you know, if we see a winner or what we believe to be a winner, we'll fund it. So without wishing to fudge it, it's not really about the brand. It's about the business. It's about, you know, its success, its cash flows, and that's what drives us. We will not say, oh, we only fund brands. We frankly fund both.
We've had a question come in. Is there a key city or perhaps a particular size of a hotel that you that the banks still have the appetite to finance?
Would you like me to answer that one?
Please,
yeah.
Please carry on, Tim.
Is there a key city? No, I can't think that there is. I think if I were to step back, I would say, you know, I think gateway cities, it is going to be challenging for another 12 months or so, because of course gateway have got, you know, far greater exposure to international travel. And you know, in general, I would say international travel is going to be more challenged in recovering. And this is, Ellie, to your point around, you know, when a market's going to recover. I think if you are predominantly domestic focused, I think you're likely to recover first. Having said that, the gateway cities are going to rebound, and you know, Louise has talked about, you know, there might well be some redesign or re-engineering in terms of what the propositions are. But people want to be in London or Manchester or Paris or wherever it is. So to answer the question, there's no focus on a particular city. I think gateway cities are going to have a longer recovery, perhaps. I mean, I don't. Who knows? Who's got a crystal ball? But you know, what I would say is that funding will have a tendency. I mean, it tends to be more. Hotel funding tends to be domestic. It tends to be funded often by domestic lenders. There is multi-jurisdictional, especially on luxury. But my view would be there's no preference. All there will be is just a reflection of how quickly the recovery is going to come, and thereby the cash flows which lenders fund against.
Thanks, Tim. And I'd like to bring Louise into the conversation here by almost stating that obviously 2020 has been a write-off for most hotels. And so I'm curious to hear as to whether 2019 performance, is that the benchmark for evaluating loans based around future performance, or has everything been rewritten and we're entering a new market?
Yeah, it's a good question, because I think a lot of the market commentary is telling us that hotels will recover to 2019 levels by 2024, but kind of silent as to what 2019 levels are. Are we talking, you know, I suppose the mix between occupancy and average daily rate, we're talking RevPAR perhaps, whereas cash flows that we're looking at, I think that they will have changed. So the customers have sat and looked at their expense items thoroughly over the last year, and have identified lots of efficiencies. And so therefore there is an assumption that actually profit margins should be higher. 2019, I think, was a good year. 2018 was also a good year. The hotel industry benefited from the devalued currency following the Brexit vote, and we were already seeing some sort of staycationing as a result of that. I think after staycationing because of expensive euro, and now because of we can't actually do anything else, we might all be desperate to get away in 2022, 2023. And so therefore there might be, you know, 2019 might be too high a hurdle for us to say we've got recovery. Perhaps we should be looking at the 2017, 2018 period. But I think 2019 NOI could be the right figure, because, as I say, we might not get there in revenue, but once you've cut out all of the inefficiencies in the cash flows, and we've got a potential for stronger profit margins, then I think that will be interesting to see, and it will be difficult to evaluate. I think customers are going to be showing us very different cash flows to what we've seen historically from them, and there will be a need for a discussion to understand, you know, how you're going to get to this new picture, whether it's reasonable, and whether or not there's any, you know, challenges that we need to be aware of. I think possibly, you know, hotels where previously they've struggled with their F&B, they may well have found a route in the current market to outsource that, and it could be a very different structure that we're looking at. And yeah, it will be interesting to see the cash flows that's submitted and the conversations that follow from those cash flows.
Thanks, Louise. And I'd like to turn now to focus specifically on the boutique hotel segment, and I'd like to come to Kim to ask, how do you see this segment growing in comparison to what you might describe as traditional hotels?
Right. So based on our research, the boutique segment, which we define as soft brand, lifestyle, and independent, all collectively have grown faster than any of the traditional hotel concepts over the past couple of years, the fastest growing segment. Supply, I'm trying to put together a report to compare how 2020, went for the boutique segment, but I would venture to guess, as it was already on a trajectory, as a fastest growing and higher performing, normally commanding a premium in rate. The experiential component, certainly a lot of revenue from the F&B portion as well, was really on a trajectory to bypass it all again. So I'm thinking as things settle out, that will continue. I think the independents need to be very tech savvy, need to make a seamless and contactless experience. The soft brand and lifestyle, which are franchise, may have a better time of that and of conveying that. But all in all, I think one of you mentioned about being local, that type of thing. Also the redefinition of the corporate segment too, and how are they going to travel and how long are they going to travel throughout the year, and are they going to want to do the corporate retreats where they bond, then the rest of the year do the Zoom? We don't know, but I think the boutique segment can answer that more readily as an experiential, you're coming here for this purpose. And so I see it moving forward as progressing as it was. I recently did some supply distribution, and there are vacancies in larger MSAs still in the United States. I think that will be investigated a little more now.
We've had a question come in about whether we think the biggest shift from this pandemic is going to be a move from the urban city business convention hotels to rural nature, leisure, wellness resorts from all sides. So taking into account customer needs, their changing tastes, but as well as the finance and transactions. Would you agree with this, Kim? Is this something that you're seeing? As if you had to take, would you agree that the biggest shift from this pandemic is going to be a move away from the urban to the rural leisure?
I think that, well, I know it was hard hit here in the US, the urban locations, the denser locations, also just home sales. I mean, people are actually physically moving out as well. So I think there may be more of a focus on the rural setting, and there's a lot of room there for the boutique product. So absolutely, I think that there may be a shift there.
And quick question here. So what type of investors do you think we're going to see increased activity from, and are they going to be looking in these rural areas?
It's interesting because Tom touched on this, and I don't know if we've seen it yet, but I know that there's an expectation for the high net worth individual buying the distressed product, and the private wealth management firms, looking for those opportunities where in the resorts or in the gateway cities, the hotels just couldn't quite make it happen. And so I think they're kind of going to swoop in and get some of that. Other than that, that's definitely the finance people's answer. But that's what we're seeing whenever we're producing reports and talking to investors. That seems to be the next trend.
Thanks, Kim. And I'd like to finish off with my question to Ben. Obviously, you mentioned that you've established your name, brand, reputation pre-COVID. You're going to ride this out very strong. So what would be your advice in terms of what skill sets are required for effective operation? And can you share some tips about successful cost management?
I'm not really one for giving advice. I'm not not sure I'm ready for that. But look, I'm not going to sort of patronise the audience by talking about squeezing a percentage of GP here or a wage percent here or there, and that's obvious. But I suppose three things that I've been focusing on a lot in the last year is be really clear on the model and be comfortable with your model. Again, our model, I've come from running apart hotels where, you know, the finances involved in that, looking at my P&L would raise a few eyebrows. But be comfortable and be clear on your model. Be really, really razor-like on your brand. And again, we're 100% leisure. We're 99% domestic, and we're also 100% direct distribution. So for us, brand is everything, and every decision we make goes through that lens. And then the third and very obvious thing is people. And again, it's been a big focus for us this year, as we've had to metaphorically put our arm around a bunch of people who we employ and have them start businesses and stop businesses. These businesses aren't built to stop and start. So emotionally, that's very hard for our teams. And again, I think this next opening on the 17th of May is probably going to be the hardest. So we have to think about what that looks like on a more tactical level, but also on a deeply strategic level around what the people plan for our cultural development over the next 5 years as we intend to grow very significantly. I think, frankly, I spend more time thinking about, and this might sound like a conflict, about how and when we spend money rather than how we save it at the moment. Because actually, if you do the things that I talked about right around brand and model, it should really take care of itself. But I think having the confidence to invest in guest experience and grow capacity at the moment is one thing that I'm thinking a lot about, because actually if we get that right, that makes a materially big impact on our business. An example is, you know, I'm waving my hands around and pointing to the we're putting half a dozen lakeside lodges within the grounds here at the lake. That will materially impact a business of our size. We cracked on and did a project down at Watergate where we delivered 7 beach lofts, which again open on the 17th of May and make a materially big impact on our cash flow as we come back out of this. So having the confidence to be able to do that, as well as think about how you manage the cost, has been really important. We've been helped by the government support, and we're super grateful for that. And actually, the interesting thing is we're being incentivized to invest over the next couple of years post the budget a couple of weeks ago, which again is another big important point for businesses of our size.
Well, thank you all. I mean, we've very quickly hit 3 p.m. I'm always surprised on these webinars just how quickly time flies, but I must say thank you to everyone for submitting their questions. Please do connect with our Trailblazers over LinkedIn. We haven't quite got round to asking them all, so please do carry on the conversation online. And obviously thank you to our Trailblazers as well for their input. I've just got a few slides that I need to run through before we do close off today. As I mentioned earlier, the Urban Living Festival is taking place this summer at Tobacco Dock in London on the 7th and 8th of July. We've spoken about it today. Isn't it just going to be fantastic to see each other in the flesh? That sounds not intended in that way, but in person, face to face. I'm super excited to see everyone at the Urban Living Festival. And if you would like to hear more, please do get in touch with my colleague Katie. Her details are on your screen now, and I believe her LinkedIn is also being posted into the chat. So thank you to everyone who has tuned in today, and thanks to our Trailblazers. I'm going to be back on Monday the 29th for the final webinar in the 2.0 Trailblazer series. And here I'm going to be looking at the changing role of hospitality media PR. If you want to get in touch before then, you can find Boutique Hotel News on all the social channels on your screen now. We would love to hear from you. Once again, thank you. Enjoy the rest of your day, and I will see you all again very soon. Thank you. Bye-bye.